Hello, and welcome everyone to the first of Frontier View's MENA through COVID-19 webinar series. Today, we will be focusing on the outlook for Egypt amid COVID-19, looking at how our projections for the market have changed and how businesses' assumptions and strategies to the market should be shifting. We also have similar webinars coming up on Saudi Arabia and the UAE, so please don't forget to register for those if you are interested. I'm Zainab Kusari Solo, the Director for Middle East Africa and Turkey Research, and I'm joined by my colleague Mansour Al-Zahab, our MENA specialist. I will pass it on to Mansour to guide us through our view on Egypt's growth outlook, the growth momentum that we have in the country, the Egyptian pound, and inflationary dynamics, as well as our outlook for demand from the government, the private sector, and consumers. You can also follow our updates on these markets and many more in Frontier View Mobile. We are very excited to share with you our new mobile application that will deliver the most up-to-date and relevant content you need to power through your daily business decisions, monitor your markets, and inform your strategic planning. And lastly, I would like to remind everyone to submit their questions throughout the webinar in the question box on the right or directly to Ducker Frontier Webinars. We will be collecting your questions throughout the webinar as you think of them and aggregating them for our Q&A session at the end. And I'll pass it on to Mansour.
Thank you for the introduction, Zainab. So I'll dig right in. Our new vision of Egypt is one of stuttering momentum. We're seeing that infection rates will remain elevated for the short term. Overall private demand will be shrinking and price sensitivity will be strengthening. All of this will push businesses to cut their output prices to stimulate sales, but will result in margin pressures as well. As for the pound, we expect to see stability, but also for it to come under some mild depreciation as reserves decrease. And with that, we will see fluctuating and fragile investor confidence in the market, but we will look at each of those fundamental drivers in more detail shortly after the global outlook. In order to navigate through COVID-19 in Egypt, we would want to take some key thematic actions. To start with, we want to protect market reach by supporting local partners and key customers, albeit whilst protecting cash flow as well. This will result in some favorable relationships in the middle and the long term. Secondly, we will want to revise market assumptions for the medium and the long term to ensure a more proactive approach to changing demand opportunities and challenges as well. Furthermore, we want to enhance scenario building practices to allow for more effective mitigation plans and more business resilience in face of new shocks. Now, that can be done through creating two downside scenarios, one of which is if the virus is not contained by the end of the quarter, and secondly, if the virus re-emerges in the winter season. Finally, we want to increase engagement in the market, be it with decision makers or through better understanding the customers in the market itself. And that can be done through either building reports with state-owned enterprises and especially military-owned enterprises in Egypt, which will increase the access to the demand pool, given that public demand will likely outweigh that of the private demand. Furthermore, we can remain close to the government officials in order to stay on top of the rapidly changing regulations. And finally, collecting insights not only about the financials, but also on the behavior and the investment tendencies of our customers and spotting their patterns in the second half of this year, which will help build more effective 2021 strategies. Now onto the global and the COVID outlook. The combination of slowing global manufacturing environment, which has been taking place before COVID, along with the COVID outbreak itself and the aftermath of the structural economic damage, we will see results of weak and fragile private confidence, a slow return to recovery that will vary across sectors, of course, debt concerns starting to rally or rallying further in emerging markets, and political ripple effects taking place. And whilst we don't expect to see COVID-19 vanish anytime soon, In fact, we actually expect it to be part of the economic weakness, which is directly driven by disruptions caused by the virus. And so, as part of our base case, whilst we expect to see secondary outbreaks in various regions, we don't envision a comprehensive lockdown of economies like what we saw back in March and April of this year. Now, social distancing measures will remain in place, and restrictions will be sporadically imposed, which will disrupt consumer dynamics and also supply chains where imposed. Finally, as for a vaccine, we don't expect one to be likely widespread before late 2021, which will dent the tourism recovery hopes. Now, the densely populated parts of Egypt unfortunately raise the risk of prolonged infection rates, hurting confidence and pressuring the healthcare system. Critical to Egypt itself, a lack of confidence in the government's COVID-19 tackling strategies will put off tourists, which are an essential source for consumption and foreign currency inflows. But the virus itself is an influential and a key growth factor across the world, not only in Egypt. We expect to see a recovery start in Q3 amongst developed markets as economies start to open up, and we've already started to see China normalize, whilst the European Union and the United States are likely to begin at some point this quarter. But a point here is that normalization does not mean returning to pre-COVID numbers or a significant rebound in growth. It instead is our new, more gradual, more fragile, and more volatile economic growth climate. And one way to see how normalization will differ is by observing the tourism sector. Whilst businesses would hope that normalization of tourism would return at some point in the second half of the year, tourism trend experts and global travel organizations expect international tourism to only start recovering in 2021. But this again, of course, differs from one country to another, subject to the containment measures and their successes and when they were affected by the virus. The Middle East and North Africa region as a whole is lagging behind compared to Europe, of when it first encountered a mass outbreak and how it is containing it. Egypt is dubbed as a slow mover in containing the virus as it stands, which is likely to delay its tourism sector recovery compared to its neighbors or the regional average. And this will result in ripple effects not only for the tourism industry itself, but also across the rest of the economy. Because consumption and therefore domestic production to meet that consumption will decline for the rest of the year.
Wow, so we have a pretty cautious global outlook here, Mansour. Quite a weak recovery, slow recovery expected, it seems, across the world. We're even expecting the European countries to return to their pre-COVID levels only in 2022. So overall, not the most conducive environment from a global economic perspective. When we contextualize Egypt there, how does COVID then change the way that Egypt is growing and will continue to grow? Because, of course, Egypt is slightly above this global average.
Well, yeah, so COVID-19 will have a lasting adverse impact on Egypt, which has actually driven us to revise down our forecast, as you can see on the slide. Now, the thing is, we kept emphasizing the point that much of Egypt's stability and economic growth is actually exogenously driven. And so if or when global factors change, such as what we saw with the COVID-19 pandemic, Egypt would become subject to a severe change in growth momentum. Now, growth will slow significantly because unlike pre-COVID-19, Egypt cannot compensate for lost external demand with domestic demand stimulus. The outbreak is affecting local employment, tourism arrivals, and confidence as well. And so now we have a situation where both the external and the internal demand are dampened. So overall growth will average around 1.7% in 2020, which unfortunately is down from 5% or just shy of 5%. And it will modestly recover at around 3.5% to 3.8% next year, again down from the 5% high growth momentum that we envisioned for Egypt before the pandemic hit. In fact, if we look a bit closer, one quarter at a time, we see that Q2, which has just ended, was the worst performing period for the year because it was at the peak of when COVID-19 shock caused mass disruption. We're in fact expecting economic contraction results from Q2 to hit nearly 4%, with consumer spending declining sharply and exports continuing that downwards trend. Whilst for Q3, we expect to see continued contraction, but at a much slower pace. Yes, the market is opening up, but COVID is still quite widespread in the country, and that will continue to dampen confidence in the market. But the critical driver here will be government spending, because the new budget, which came into effect at the start of this month in July, sees higher spending to support consumers and businesses in order to stimulate economic and business activity. But we're also seeing increased investment as a result of that, which is why we expect to see a jump in investment growth. Of course, most of that will be coming from public projects, because foreign demand is unlikely to recover before 2021. Now, as for the currency, we should expect a stable pound with mild depreciation for the next 12 to 18 months, because the way we see it is that we have two forces at play. On one hand, we have the falling currency reserves in the central bank, as the emerging market sell-off pushed the Egyptian central bank to spend nearly 11% of its reserves to buy back the capital. And you can see that on the graph in the middle, where you see that sudden dip at the start of the year. But then again, on the other hand, we see government intervention, which has kept the Egyptian pound from depreciating sharply because the government sought to limit the damage on the already fragile domestic demand recovery. And also we're seeing that foreign lending is replenishing reserves to some extent. So with that, we expect to see the pound at around 16.5 against the dollar for this year, and just at around 17 for next year as the government gradually starts to reduce its intervention. Now, of course, different businesses in the market will have access to different exchange rates. Essential goods, food staples and whatnot will probably have access to more favorable exchange rates, whilst durable goods and intermediary goods are likely to have exchange rates closer to the real market, so a less favorable or a marginally less favorable foreign exchange rate at the point of importation. So it is essential to engage with the right people, engage with the authorities in order to understand what exchange rate you or your partners are accessing, and how will that factor in to both the second half business strategy or our 2021 calculations as well. Now, that government intervention is also playing a role in keeping inflation moderate, because alongside subdued demand and the falling energy prices globally, the state has pumped into the market a selection of cheap basic goods to avoid a spike in prices at the very peak of the virus, prior to the lockdown, when we saw that surge of consumption and stockpiling. Now, businesses will continue to find it challenging to raise prices, and instead we expect to see more of the ongoing discounting practices in order to stimulate sales. And thus inflation is expected to average just shy of 6% this year, and a mild increase to 7% in 2021, when domestic and foreign demand starts to recover and we start to see some of that domestic consumption really rally. And that moderate inflation will allow for the central bank to cut interest rates, further supporting the currently weak investor confidence. Now, the central bank has already cut rates rather markedly this year, and we've seen it come down to the lending rate has decreased to just above 10% because of that market 3% cut that we saw back in March when the government tried to tackle the COVID-19 disruptions, and that is resulting in higher demand for cheapening credit. Now, this presents an opportunity for businesses looking to stimulate sales by offering the option to purchase on finance or on credit. But that has to be done where financially viable and where it is sound to do so. A further interest rate cut is likely to take place in the second half of the year, but it will be of a much smaller magnitude, and it will be contingent on inflation remaining moderate. But we should not be expecting another major cut because the central bank faces the dilemma of, yes, stimulating the economy, but it also needs to maintain the interests of the bondholders that are necessary to continue supporting the government and funding its public spending through the continuous news that we hear about new bonds being issued and Egypt remaining to be a lucrative market for foreign investors.
So it seems the central bank has done its share as much as it can in terms of lowering rates, maybe a little bit more to go, but not necessarily major stimulus room left on that side. What is the government doing to resurrect some of this momentum for growth then?
Well, along with interest rates, the government is exploring other means to stimulate the economy. We've already seen that through the $6.5 billion stimulus package back earlier this year, which included raising public wages, introducing public sector bonuses, tax discounts for businesses, and debt relief of up to 50% for the most vulnerable firms at risk of default. But while this expanded spending is likely to boost investor confidence for the short term, it will create concerns in the long term over mounting debt. The expanded spending is also actually being extended into the next 12 months, as the new government budget shows a 9% increase in overall spending. In fact, the finance bill is actually built on increasing support to consumers by increasing wages and raising the tax bracket threshold. Now, if we observe the graph and from the highlights of the fiscal bill that we've seen, investment spending is rising by nearly a third, and we're seeing that key segments like healthcare spending, for example, rising by up to 45%. So there is a clear notion there by the government and a clear intent to try to bring Egypt back to that growth momentum as close as possible, stimulate business, stimulate consumption, and accelerate that recovery through and post COVID-19 as well. But in fact, if we look a bit closer into the healthcare, we're seeing that there is increased resources provided to procurement and capex as the government plans for a second phase of the National Health Insurance Program, and it looks to prepare its economy and prepare its citizens to battle COVID-19 and return as much of that consumer and business and private confidence as possible in order to get back on that recovery track.
And I think it's actually quite important for us to pause here for a moment on the National Health Insurance Program, Mansour, especially for, of course, healthcare companies, but not just for those, actually for consumer goods companies, companies selling industrial products as well. This is a program that's going to be impacting the entire population and many industries. We have in Egypt around 80% of total private health expenditure, but 60% of total health expenditure actually coming out of pocket from consumers. And then when we look at the consumers' regular spending itself, 10% of it regularly goes to healthcare, and that's actually quite a high average. When you compare it to, for example, the GCC, we see that average at around 2. When you compare it to the rest of North Africa, that's around 6 to 7% of total spending. So there's actually a lot of money that Egyptians end up spending on healthcare, which, if this reform can actually go ahead, could be helping consumers increase a bit more of that discretionary spending into the future. And that's, of course, very important. But on the other side, for all businesses, I'm assuming there are some tax plans, or at least some ways in which the government is trying to fund this program that could actually impact operating costs. So why don't you give us a bit more of an update on this program, Mansour?
Well, yeah, so as part of the government's long-term policy plans, Egypt wants to increase medical coverage, it wants to reform the public healthcare space, and it wants to support its economy by doing so. Now, this will come in shape of the new National Health Insurance Program, and I might refer to it as the NHI for the rest of the discussion. The new program aims to have all 100 million Egyptians covered in some form. But the project is quite huge. It is costly and it is significantly dependent on government revenues. In fact, we've already seen the timeline of the rollout of NHI and the completion of the NHI has already been extended. It was originally meant to be around 5 years, but now we're seeing it to just over 10 years. And so continuously monitoring the government revenues will help create more accurate timelines for public demand spikes. As for non-healthcare businesses, there is a liability to ensure compliance with the corporate and the employee contributions through the paycheck deductions and the corporate healthcare tax. Now, a sudden shift in government revenues could push the government to pass on more of the burden on companies and the economy in order to help it out with funding the program. We've already seen some example of that just recently with the new COVID tax, that 1% tax. That in itself is an example of when the government is coming under pressure through its revenues, but wants to continue through its projects and through its spending, but will push some of the burden onto the private economy. But the new NHI will bring about structural changes to the industry itself, which includes increased localization incentives, bigger focus on telemedicine and other digital solutions, and widespread constructions of new or the renovation of existing hospitals to cater for the higher demand. We've already seen that through an acceleration of that with the COVID-19 pressure mounting. So we've seen some of the hospitals being brought up and pent up quite quickly in order to combat the infection rate.
And I guess, of course, just for the NHI, this is a very large program, but not just for that, but of course, we're seeing the government, I guess, plan a lot of expenditures this year. How is the government able to fund or afford all this ambitious spending programs?
Well, Egypt's expanded spending is based on expectations of increased revenues. And these targets may be a bit too ambitious given the current economic climate, not only in Egypt, but globally, of course. Now, the government is banking on its increased spending to stimulate the economy. But then again, there is always a risk that a second wave of COVID-19 infections can suddenly, abruptly, and harshly damage confidence once again. So B2G firms here need to carefully manage demand expectations because we are anticipating rather government spending to increase, yes, but not at the same height of the official state expectations. And we also advocate for creating downside scenarios where the government revenues shrink sharply, preventing the spending target to be met. Now, this is exemplified through that 14% target the government set to grow the revenues at in the very first column on the chart in front of you. That 14% target is quite high compared to the recovery that we were seeing last year, but also the current situation that the global economy is in. In fact, we already are expecting that the government will likely miss its fiscal year 2019-2020 target that has just been completed because of that sharp decline in consumption driven by the lockdowns. And this unfortunately has been a problem seen many times before, whereby you can see the green columns in the chart, which represent the actual revenues, fall below that target line in burgundy. And some recent examples is, for example, why we're seeing the National Health Insurance Program be stretched over a longer time frame. It comes down to the fact that it is because the government realistically cannot meet all its spending targets and complete such huge projects and fund it in such a short time frame as they envisioned before because of that pressure on the state coffers. And instead, we're actually expecting to see the NHI now, rather than be completed by 2024, be completed in 2030 or by 2032. So that is the benchmark for us in the economy to have contingency plans and factor in downside scenarios that some public projects may not be able to complete it in the original vision of time frame that was had at the start of them. Additionally, also other sources of finances are coming under pressure because borrowing is becoming more expensive, and that's not only just for Egypt, that's emerging markets as a whole, In fact, actually, Egypt is maybe on the more positive side, but it is still seeing its borrowing costs climbing slightly. And also, we have global trade slowing down, which will risk the Suez Canal receipts, and tax revenues will decline organically as consumption remains subdued. Now, the IMF greenlit Egypt's financial support, which came as a positive boost, which will help fund some of the government spending plans. But this also comes with its own issues, including a rising debt ratio, which had been actually improving before COVID-19. So the government was on track. Investors will grow more concerned unless Egypt returns to its debt managing program. And the IMF funding will be subject to the country continuing its reforms, which could see that the fiscal year budget of 2021 and 2022, so not the one that has just started now, but the one that will come after it, could potentially see that budget slashed in order to consolidate fiscal balances.
And of course, as all of this is happening, as you mentioned, the investor confidence is quite critical, either to attract those investments or to either to the direct economy or even to bond issuances. What is this investor sentiment like today compared to, for example, last year, given all the latest COVID developments? Will we see a return of that investment appetite towards Egypt?
Well, this time last year, we were discussing the timeline of when investors will put their second foot through the door, as they were waiting to see if Egypt's stability was legitimate and whether the opportunities that were poised to actually surface would. There was a lot of excitement on Egypt, and it was building up. But of course, investors just wanted to make sure that the investment and the ROI would be sound in the aftermath of the 2016 crisis. And so we saw positive results, actually. We saw that the momentum of investment was picking up in the latter parts of the year and in the first couple of months of this year as well, actually. But since the pandemic hit, we saw that investors started to reverse their step forward and actually resort back to their wait-and-see position. Now for 2020, we are still seeing a positive trajectory, but at a much slower and more gradual pace, before it starts to pick up again in 2021. That 5% growth that we're seeing or we're forecasting for 2020 will actually be driven overwhelmingly by public projects as per the new budget. And particularly speaking, we'll probably see it go through infrastructure projects and healthcare projects. Therefore, we would want to enhance our engagement with the government in order to better understand their priorities and improve access to the demand pool, understand where that demand opportunity lies, given that it's sporadic, and actually capitalize on it. Whilst on the other hand, we don't see private investment improving anytime soon. This is due to a combination of stronger inertia from foreign investors towards emerging markets and lower expansion justification as exports fall and capacity utilization remains mediocre. But we do want to collect and continue collecting customer insights, and we want to align with our local partners on monitoring the market to remain at the forefront of being able to capture demand once it returns in 2021. Collecting the insights today, understanding the feedback on our product, understanding where there is a gap in the market, and understanding how our customers' prioritizations and their needs have shifted because of this phenomenal and unprecedented crises that we're all going through will change the projections and the tendencies of demand and their dynamics as well over the coming medium to long term. And also because despite investors actually selling off capital in Egypt at the peak of the virus, Egypt actually remains quite interesting for foreign investors, and the country actually remains to be at the top of the priority list from investors. There is still an itch to come back into Egypt, and some investors are already planning how to put their second foot through the door once again. But of course, the timeline of recovery will differ from one industry to another, depending on their exposure to COVID-19 disruptions. Durable goods are expected to suffer a longer delay to recovery as opposed to essential goods, of course, whilst tourism is unlikely to return until maybe mid 2021, because unfortunately tourists remain doubtful over Egypt's coronavirus containment efforts, given that infection rates remain relatively elevated. Well, for the manufacturing sector, we will begin to see a recovery at the end of this year or early 2021, but that recovery will be gradual as well. And that will happen as demand from the GCC or the Arab Gulf and Europe start to pick up again. And it's important to note here that we were already seeing some structural changes in the exports and in the industrial performance in Egypt. Because even before COVID-19 struck, we were seeing a global trend of slowing performance in the industrial and the construction sector, globally speaking, which trickled down into Europe and also into Egypt. And that could be seen in both the graphs, actually. So on the left-hand side, you can see that your indices started to drop towards the latter part of last year, whilst energy production and particularly energy consumption started to decline in November. Now, the graph on the right, once the data comes in and once the confirmation of the data comes in, we expect to see a more significant fall off in April when industrial production came to halt with the lockdown measures that had to be imposed in face of COVID-19. And we can actually take an example of a particular manufacturing segment, which is the automotive sector. COVID-19 disrupted and derailed Egypt's automotive sector recovery, actually, and we should expect a poor second half of 2020 demand climate, with consumer confidence remaining weak and numerous automotive localizations and expansion investments actually being deferred. The way we see it is that on the demand side, you have market uncertainty, price sensitivity, disrupted real incomes, and the barring of cash payments in such a cash-heavy market will result in demand remaining subdued until at least the middle of next year. Whilst on the supply side, companies are facing extreme liquidity constraints, particularly in the private sector, and instead are launching cost-cutting initiatives. Now, upon return of recovery, we should expect local partners to request cost-cutting input prices as margins are pressured and will remain to be so, whilst, of course, retail prices have to be discounted, as we said, in order to stimulate spending. And if we move on to actually seeing what's happening in the private sector in itself, as demand remains subdued, businesses will come under increasing pressure to discount their prices in order, of course, to maintain the sales figures that we've been saying. And this will be further exacerbated by the increased competition from the military-owned enterprises that are producing substitutable goods. As a result, business margins will erode, resulting in potentially some subpar cost-cutting exercises and increased payment delays. Now, where possible, it could be constructive to increase flexibility to partners and widen their credit lines in order to allow for them to capitalize on the sporadic pockets of demand rather than miss out on them due to cash flow hurdles. But this, however, should be done in a case-by-case manner where financially sound in order to avoid exposing our own financial stability to the potential partners' financial deterioration. And for consumers, despite the government's best efforts to support consumers, spendings will contract by nearly 1% this year. From actually, we were previously expecting to see a pickup and a significant recovery, but instead we're seeing a 1% contraction. And we expect to see an increase in price sensitivity on the back of increased unemployment and the absence of tourism, which normally contributes to a significant amount of domestic consumption. Now, demand for small ticket purchases and essentials will remain resilient, but face some price competition and of course, because of that, increased substitutable goods that are being introduced into the market. However, big ticket purchases will likely be delayed to 2021 as consumer inertia strengthens. So we should avoid pursuing aggressive pricing strategies to avoid further sales loss. A gradual recovery will start later this year, building into 2021, where the average growth will moderately increase to just over 2%. Prior to COVID-19, Egypt's middle income class was on a recovery path following the 2016 economic crisis. Now, this has since paused as the middle income bracket is facing potentially the biggest change in the momentum direction since the outbreak, and will only resume resurgence by maybe mid-2021. Revising the product mix to incorporate more intermediately priced products will help capture demand from the transitioning consumers who are trading up, but albeit doing so at a more price-sensitive manner. And so that wraps up our outlook for the drivers. And now we will look into what are the implications for the multinational companies and what could be done to tackle that. Therefore, if we put everything together, we can highlight that there are some thematic implications across the board for our business in the next 12 months. We see infection risk will remain elevated, customer behavior and preferences will continue to change as confidence remains fragile. Distribution challenges will remain due to the haphazard reopenings, and foreign exchange limitations and the liquidity issues will return or bring back payment challenges. And finally, price increases may come with the risk of market share loss, especially due to the challenges around price consistency. And so updating our market assumptions and understanding the customer segments will help build a better long-term sustainable presence in Egypt. And we can look at that through three different phases or three different objectives. Firstly, to increase sales in the short and the medium term, we would want to avoid aggressive pricing. We want to introduce mid-price goods, and we want to increase credit buying options. As for the objective to widen market reach in the medium to the long term, we would want to increase engagement with the key decision makers, and we want to collect market insights, and we want to increase online presence. And that becomes particularly important as we saw that sudden surge in e-commerce transactions building up with the lockdowns that prevented consumers from going to brick and mortar typical retail. And as for the final objective, to build a long-term sustainable place in the market, we want to align with local partners and invest in their capabilities. We want to increase marketing efforts to enhance brand awareness, and we want to build short and long-term scenarios to mitigate volatility and any potential business shocks that we could be subjected to, as what we've seen with COVID-19, even if it's at a less unprecedented scale or a less shocking scale as that. And so with that, we wrap up our suggested actions with Egypt before passing it on to, passing it on to Zain.
Thank you, Mansour, for the very detailed outlook on Egypt. Now, we have been receiving questions throughout the webinar. Thank you very much, everyone that has been submitting their questions, and we'll be asking them in the next kind of 10 to 15 minutes to Mansour. And actually, I would like to start by clarifying in one of the questions that we've received around our assumptions about the coronavirus itself. So all the forecasts that you have been seeing in this presentation, they assume that the virus will stay with us in the kind of next 6 to 8 months in the foreseeable future, and that this existence of the virus, ongoing rates of infection, that will actually cause some sporadic, temporary, but localized restrictions of mobility across the world. So we will see them happening in parts of Europe, parts of Asia, parts of the United States, and parts of course, the Middle East. And these, of course, mean that over the next 6 months, especially, international travel is going to be quite difficult to return to normal. And of course, what this is different to is a second wave, to the extent that we see simultaneous lockdowns of entire nationwide restrictions that would happen, of course, at the same time in US, Asia, and Europe. That we do not expect. That would be a downside scenario, and that would cause further downward revisions to the numbers that you have been seeing here. So hope that has been clarified. But there are a few more detailed questions on Egypt. The first one is the tourism sector, of course, very critical to Egypt. Mansour, what is the tourism sector's contribution to Egypt's economy? How dependent is the country on the tourism industry?
Tourism plays a very essential role in Egypt's economy, and it is one of the reasons why the government is pumping so much investment into building up that tourism sector, and it was working so hard on trying to improve the perception of national security in order to bring back tourists as quickly as possible post the Arab Spring and some of the other national security issues that happened afterwards. In figures, tourism makes up between 10 to 12% of the GDP. And actually, it employs up to 14% of the employment, and also it employs probably more in the shadow economy, which still contributes to some consumption overall, and plays a role, of course, in the domestic consumption. And now, with the shocks that we're seeing COVID-19 create to tourism, there are concerns and there are adverse implications on the overall consumption, because not only we're seeing that tourist consumption domestically decreasing, but we're seeing that the income that tourism creates for Egyptian households are decreasing, which in turn will also decrease that ability to consume domestically as well.
Mm-hmm. And thank you, Mansour. There we have one more question around government spending. We have our forecasts, which actually is the case in many other countries that we see across the world. We have government spending growing at a certain rate this year and slightly slower in 2021. How can we explain this change, basically slightly lower government spending growth next year versus this year?
Well, that in part comes into the spending plans that the government brought in. When we look at the stimulus package that the government introduced in March and April, and also the new budget. So one thing to note here is that we work our forecasts are of calendar years, so January to December, whilst the government plans go on from July to June. The fiscal year is a bit different. But at the start of this year, we saw that the Egyptian government put aside $6.5 billion in order to combat COVID-19. That is an enormous sum. On top of that, we're seeing other spending packages being introduced by the government, including the one that is actually being discussed right now, where the government wants to put around 12 billion Egyptian pounds into the economy to stimulate consumption. All of this spending, along with the increased spending in the budget, creates a higher overall growth in public spending compared to the previous year. Because in the previous year, we were seeing that Egypt was changing the way it was spending more so than it was increasing its spending. So overall spending last year in Egypt remained rather flat, but they were moving and shuffling resources from your typical operating expenditure such as subsidies and whatnot. They were shifting that resources into capital expenditure and investment. So you had a low base effect from last year. Now this year you have an increased overall spending in the budget, which is 9% bigger. And on top of that, you have in the first 6 months of this year, you have increased spending or tangible spending from the 6.5 billion and the other packages, stimulus packages that the government is introducing in order to tackle the COVID-19. Now, for the following year, we don't expect another increase of this kind of spending. At most, we would expect to see maybe some slowing down of spending because the government will have to tighten its belt a bit in order to return to normality after having spent so much this year. And so next year we'll also have what we call a high base effect. So the growth is on top of high spending in 2020. So next year we will see more flattening spending compared to this year because we're expecting to see an absence of that sudden shock that will push the government to spend a lot more to stimulate the economy.
Mm-hmm. And I think maybe it's important here to clarify that actually this is quite consistent with what we're seeing across the world, across the rest of the Middle East region as well. But in terms of the other countries in the world, a lot of governments are pulling forward all of their fiscal stimulus as much as possible now, but of course this is resulting in rising debt into next year, and a lot of governments will have to consolidate their expenditures into next year. And actually this is a good connection to another question we received on whether we are able to benchmark Egypt's economic indicators to other countries in the Middle East. First of all of our clients on the line, of course, you can access all of our data on Egypt and compare it to other MENA averages, for example, or global emerging markets averages through your portal in the Data Explorer section. But just to give you a general sense of how Egypt compares to the rest of the Middle East, actually on the GDP level especially, we are seeing that Egypt has one of the highest growth figures in this region, and that's mainly, as Mansour mentioned throughout the presentation, mainly due to very strong government spending support going into the economy this year. When you compare it to other countries, we have in the Middle East, of course, ranging from -10 to -9 recessions of GDP in Algeria and Iran, for example, and then we still see the GCC countries all actually in recession this year, their growth rates ranging between -2 to -5%. And that's mainly because these governments have decided to consolidate spending this year. Consumers are experiencing very similar trends across the world, but it's more the government decisions that are differentiating the countries right now, and many other governments are choosing not to raise their debt levels as much as, for example, Egypt is choosing to do so right now to be able to support the local economy. And so I think we have one more question, Mansour, on the situation of Egyptian businesses on the ground. We've talked quite a bit about the general situation. How are the Egyptian local firms experiencing right now this current situation?
It is in fact a complex and challenging one. What businesses are facing right now is significant margin pressures. As you said, yes, the global oil price declines are helping producers cut costs a bit, and their input costs are declining to some extent. But at the same time, the shock of COVID-19 and that fall in demand and the exports are also putting a significant amount of pressure on meeting those sales targets. And so businesses are in competition in the market itself in order to cut prices and actually stimulate and discount and promote more sales, because as we said, almost all private demand and even public demand is price sensitive, and it is of weak confidence. Now, this again, as we said, is exacerbated by that competition that military-owned enterprises are creating, and that also creates operational challenges for businesses in the market. And this is particularly important for the businesses that are producing essential goods or basic goods or food staples. Whilst for durable goods and more luxury good producers, they're facing a rise in import costs and import duties and also development tax. And now, because of that margin pressure, they will excuse me, they will find it rather difficult to actually pass on that pressure or these costs, these growing costs onto the consumer because of that already inert consumer dynamic demand. And that will only further actually worsen that pressure on the margins for the next 12 to 18 months. Now, recently, as we said, we've heard of that new plan that the government is putting forward, where it wants to put aside about 12 billion Egyptian pounds in order to stimulate a target of 100 billion Egyptian pounds. So that could be activated through subsidies or bursaries to producers and also cash handouts to consumers. So we would, as a business, we would want to, engage with the government and understand how will that work. We know that will start in late July as things stand, and it will go on for 3 months. But how will that program work? And to understand that, we want to engage with the government to maximize and access those potential bursaries or subsidies or government support in order to relieve some pressure on the margins, but also push forward with improving our sales output.
Mm-hmm. And I guess this is an environment where, especially in Egypt, with the population that we have, but also, of course, across the world, everyone is focused on the unemployment situation. We have received another question on Egypt's current unemployment rate. I'm not sure if we have, of course, the latest number, but Mansour, can you give us an outlook on unemployment in Egypt and the latest confirmed figures that we have?
Well, unemployment has actually been improving recently since 2016, in Egypt. So we were seeing a decline in unemployment. In fact, I think before COVID hit, we were seeing potentially unemployment falling to around 7.7% in the first quarter of 2020 compared to just above 8% in the same period a year ago. But since COVID-19 struck, unfortunately, we're seeing that businesses are having to reduce employment, and actually we're seeing an increased cutting of jobs in order to cut costs and survive this pandemic, which is likely to push back up the unemployment figures closer to the 10% mark for the rest of the year, and even maybe till at least maybe middle of next year, because businesses are, yes, positive, but the positivity only will start after the middle of next year. So you're seeing a significant cut in employment figures over the last 4 months now in Egypt, because businesses are struggling to keep their cash flow in the black. So unfortunately, it will be climbing before it starts to recover once again towards the second half of next year.
Mm-hmm. Thank you, Mansour. We have 1 or 2 more questions. I don't know if we will have time for all, but if you can give us a quick view on the Egyptian pound. You shared with us a relatively stable pound, but is there a major risk to depreciation there, or what should we be kind of factoring in for the pound, just in terms of a risk perspective?
Well, the key driver in the stability of the Egyptian pound is the government intervention. So they're pumping money into the economy in order to prevent a sharp decline or a sharp depreciation in order to support those consumers and businesses. The risk basically then comes through how long can the government continue to support the Egyptian pound. Now, our perspective on the matter is that government intervention will decline and will gradually be pulled out over the next 6 to 9 months. because once confidence starts to recover after that initial shock of COVID-19, then the government can afford to return the Egyptian pound to its real market value, which we perceive at around 17%, 17 pounds, sorry, which is not very different from 16.5. But if we see a second wave of infections and we see market disruptions happening and we see a global shock which would decline or decrease the inflows of hard currency into the economy, then at that point the government will be under more pressure and will not be able to afford keeping the Egyptian pound at a stable level, which would then bring down or cause a more significant depreciation to 19 or 20 pounds. For the time being, that's a low effect, but a low probability, but it is certainly a risk that we want to watch out for and build into our downside scenarios, that if investment confidence does not recover, if tourism is delayed further, if COVID infections increase, then inflows of hard currency decline, and the ability for the central bank and for the government to maintain that state intervention and keep the pound stable will weaken, and that will create a more market depreciation, unfortunately.
Thank you, Mansour. And the last question I'll try to answer, and of course our clients interested more on this can find our exact forecasts in our portal, is our outlook on the euro-dollar exchange rate. There, of course, we have seen an important strengthening of the dollar because of the severe just increased risk sentiment across international financial markets. We do expect that this year the dollar would strengthen against the euro, but actually moving into next year, the annual average would actually be in favor of the euro next year. What has been taking place just lately is, of course, what we really need to monitor is whether the latest COVID situation in the US, whether that's going to decrease confidence towards the US economy. Of course, just in the last few weeks, we've had recent data coming out supporting employment figures in the US, and very much with the latest opening up news, there was a sense of confidence that actually further strengthened the dollar in the last few weeks, but definitely important to monitor the potential for slight weakness in the dollar in the near future. But overall, our forecasts do expect that this year's strengthening is a bit temporary due to the COVID-19 risk sentiment. But we can always follow up on this and many other questions that our audience has had in conversations with our clients. Thank you very much, everyone, for joining our session today. We will make sure to answer all the remaining questions through email. We will definitely get back to you. You will also receive the recording and our presentation deck tomorrow. Thank you all very much for joining, and wishing you a good week ahead.
Thank you all.